Hi everyone, this is Ben Ryan. We're back with another edition of Stock Talk, here with Financials and Housing Sector Head Josh Steiner. Josh is going to go through our Q3 housing themes, his Q3 housing themes, I should say, that he rolled out 2 weeks ago. If you do have questions for Josh that are housing related or financials related, go ahead and pop them in the dialog box below the video feed, and I'll do my best to get to all of them. Josh, I'll hand it to you.
Great. Well, thanks everybody for taking the time. So it feels like deja vu all over again here. Yeah. We did cover this a little bit this morning, so anybody who's sort of coming back for the double header, this may sound a bit familiar. So let's roll through some of these slides. So, just by way of quick background, every quarter as part of our process, we roll out like 150 page themes deck where we sort of take stock of short-term, intermediate-term, longer-term dynamics affecting the housing sector. And usually we like to start that out with a quick wrap on performance so far. So these slides are taken from our July 12th presentation, so any sort of performance metrics and so forth come from as of that date. Yeah. So anyway, where are we so far this year? Well, housing has had a very good year so far. It's actually among the best performing sectors in the market. You can see here the S15 home, the XHB, the ITB, all different proxies for the home building space or for the home housing space are sort of at or at the top of the leaderboard. And even in the second quarter, which is unusual because normally there's a lot of seasonality in housing equity performance. So housing stocks tend to do really well from October through February, not so well typically in the second and third quarter. So to see them not only performing well year to date, but as well in the second quarter as well is both unusual and encouraging. And then if we look sort of more specifically at which areas within housing are doing the best, it's unquestionably, at least year to date, been the home builders. And they're up 32%, or were as of the date of this presentation in mid-July. But really the whole complex, with the exception of REITs, which obviously have not fared well in a generally rising rate environment, the whole complex has done well, up 10 to 15%. Year to date, so across title insurers, mortgage insurers, home improvement companies, building products companies, so it's been pretty broad-based. And then a couple quick call-outs here from some of the different industry operators. So we've got Toll Brothers out basically saying this is the best spring selling season we've had in 10 years. We've got the CEO of Lennar basically saying that some of the weaker recent reports on starts and permits have been a very bad read due to sort of sampling and seasonality errors on what's going on. And in fact, the environment's extremely strong. And then LGI Homes, ticker LGIH, which is a Texas-based home builder, smaller builder, but very sizable in Texas, basically reported that volumes are up 75% year over year in June. With that sort of quick backdrop from an equity performance standpoint, I thought we'd roll into some of the fundamental trends in the market. So first things first, on slide 9, just a quick point we would make is that because of Easter floating around, you do tend to see distortion, basically weakness followed by strength that's sort of artificial and sort of a byproduct of seasonal adjustment factors. That was the case again this year, so when the data all of a sudden started appearing to be weak, we try to explain to people that in fact it isn't, and sure enough we came through sort of on the other side of that. So that was sort of more of a 2Q phenomenon. I guess taking a step back on this next page, Fannie Mae's Home Purchase Sentiment Index, which is a monthly survey they conduct. They ask a lot of different questions, obviously geared around the housing market and sentiment on the part of buyers and sellers and a lot of other constituencies. Basically, this trend is really the one that I think pretty aptly characterizes what's going on in the broader market, namely that things are steadily, though slowly, improving. And then if we look at sales of existing homes across the country, basically we've been in the mid-fives, meaning roughly 5.5 million units on a seasonally adjusted annualized rate. We've been there basically for the last 6 months. We're sort of growing at a low single-digit rate year over year. We just got June numbers very recently, basically lackluster but not negative, plus 70 basis points year over year. No real surprise there. Essentially the problem isn't that there isn't demand for homes, but rather that there isn't supply, which we'll get to. And then if we think about sort of upside, downside of existing home sales, we've got a chart here that basically sort of looks at the history of the sector over basically the last 50 years. and what sort of historically population adjusted peaks in home sales have looked like versus troughs. And there is still some upside, about 12% by our calculations, versus about 36% downside. So obviously that's sort of asymmetric to the downside. However, it is important to remember that cycles tend to be peak to trough, trough to peak. And we still think we've got a lot of track here. And part of the reason why we think we have a lot of track is because underwriting is still quite tight. And we'll cover that in a minute. So I mentioned that supply was tight. How tight is it? So 4.2 months of supply is the current reading. The thing about supply is that the inventory numbers are not seasonally adjusted, and inventory is very seasonal. Most people tend to list their homes for sale in the spring, not as many in the winter. And so as a result, you sort of have to look at these numbers, whether it's raw units of inventory or even month supply, where the denominator is not adjusted, as year over year. And on that basis, sort of where we are right now, in May and in June, on a month supply basis, it's the lowest level of inventory ever. So if we look at the new home market for a minute, starts and permits on the single family side have generally been trending higher over the past year. They were a little weak in April, a little weak in May. We sort of talked about this seasonality phenomenon from Easter. We did get the June print subsequent to putting these slides together, and the June print was very strong and basically resumed that upward trend. On the multifamily side, the trend is not good. The trend is basically flat to down, and that's following several years during which multifamily, really apartment construction, was growing at mid-teens to 20% rates year over year. And so we finally begun to see the tide turn here, where single family is sort of picking up the slack, multifamily is becoming basically sideways. If we do the same thing we did with existing home sales, but instead look at the new construction market, look at housing starts, we've got this chart here that basically shows very high degree of asymmetry, so roughly 84% upside to prior peak levels of construction, versus only about 20% or 23% downside to prior trough levels. And so you've got really a 4-to-1 asymmetry setup, upside to downside. When I was on the buy side, the thing we always looked for was at least 2-to-1, and here you've got 4-to-1. So I think as you take a step back and you think about sort of bigger picture secular tailwinds and sort of durable bull markets that are still out there at this point in the cycle, housing is certainly one of them. I think it's a bit rare in that regard as well. On the affordability side, this is ultimately what sort of brings cycles to an end and sort of causes them to sort of bottom out at the other end of the spectrum. And if you look at mortgage payments relative to rental payments, cycles have historically peaked when mortgage payments get to double rental payments from a median standpoint. And they've tended to trough at around parity. And that's actually about where we are, much closer to parity than to double. So that bodes well for housing's ongoing recovery. And then if you do the same thing, but instead of looking at mortgage payments relative to rental payments, look at mortgage payments relative to incomes, you've got a similar conclusion. Basically, housing is very affordable at the national level. Obviously, the nation is sort of a composite of a lot of local markets, some of which are affordable, others aren't. But at the national level, affordability is still extremely good. And so we think this basically means that housing has still got a long way to go. So what are some of the things that are going to continue to sort of propel housing in this up and to the right direction? One of them is underwriting. And so we've got this slide here that basically just is a reminder of where mortgages come from in this country. Most of them come from Fannie and Freddie. A decent chunk still come directly from the government in the form of FHA loans and VA loans. And then about a quarter come from portfolio loans. So Fannie does a quarterly survey, Fannie Mae does a quarterly survey, basically their mortgage lender sentiment survey, where they ask lenders essentially whether they expect to ease their lending standards on a go-forward basis. And now for the second quarter, basically 6 months in a row, the net percentage of respondents coming back saying that they do expect to ease standards has been going up and up quite significantly. And one of the reasons why, as we show on this next slide, is basically because there's not a lot of business left to be done on the refi side. right? So if you're in the business of originating loans, they're either purchase loans or refi loans, and if there's not a lot of refi loans left,
Yeah.
there's
We
only,
chatted about this earlier. It's pretty interesting.
so there's not a lot of ways to go here if you're a mortgage producer. And what that means is that basically in order to keep the lights on, these guys are going to have to get more competitive with each other for volume, and the only way you can really compete is on standards.
Yeah.
So if we look at standards, where they are today versus where they were, this is one measure. This is the Mortgage Credit Availability Index that comes out from the Mortgage Bankers Association. It's basically a monthly survey that comes out. If you look at where we are today versus where we were about 5 or 6 years ago, we've made progress. We've basically moved up from an index level of around 100 to 180. But if you take a longer term snapshot, as we show on this next slide, we've still got a pretty long way to go. So 800 is certainly the wrong number. 100 is the wrong number. I think where we're ultimately headed, and it'll probably take us another 5 or 6 or 7 years to get back there, is somewhere into this sort of 300 or 350 range. I think that's a healthy level of underwriting, one in which you're taking a decent amount of risk. But remember, the thing about risk is that there's opportunity cost associated with not extending credit to a great number of people, right? Yeah. So one analysis that's been undertaken to sort of gauge how many people sort of don't have access to credit today versus would have access to credit today if underwriting standards were about in line with where they were from the 2001 to 2003 timeframe, estimates that roughly 1 million people per year don't have access to mortgage credit. And that's a lot, because right now you're issuing around 3.5 million purchase mortgages per year. So you're talking like close to 30%.
Yeah. What do you think so you think most of the foul play was after that period?
Well, yeah, the period, and you can kind of see it on this chart with underwriting standards, right? The period where you got into all these sort of liar loans and ninja loans and no income, no assets, no verification whatsoever, basically no down payment, and in some cases even negatively amortizing product, option arms, et cetera. That really sort of began to explode in 2005, 2006. And then continued through 2007, finally started to roll over in 2008. So if you go back to sort of the 2001, 2002, 2003 time period, that was a pretty healthy level of risk taking. I think it's a reasonable benchmark for where an appropriate level of risk is, right? Yeah. Because obviously, in the wake of a crisis, politicians and regulators basically want there to be no risk taken whatsoever, but there's a cost associated with that, yep. Right? And so the cost is that basically 1 million people a year can't get a mortgage. Yeah. And a lot of those people, the vast majority in fact, would ultimately become good payers on those mortgages. Yeah. And then the other thing to think about is there's a societal cost too, right? Because for the vast majority of Americans, the number one way in which they build wealth over the course of their life is homeownership, right? They just chip away at that principle over 10, 20, 30 years. And one day they wake up and they have a very significant equity position in the home. And if they're never in a position to be able to do that, you're really destroying sort of the
plus the opportunity. I guess the lenders miss out too, right?
Yeah, the lenders miss out. And look, the problem with the lenders is that basically they don't want to make loans because the way it works is, you have these sort of underwriting boxes that you have to check for Fannie and Freddie and FHA. And then lenders are so gun shy around putback risk and False Claims Act lawsuits from FHA that they actually add additional what are called overlays on top of this. So if Fannie and Freddie basically say 620 on FICO, a lot of lenders are going to overlay that and basically say our cutoff is 645. Got it. And if Fannie says DTI is 45, a lot are going to say we're not willing to go over 42 and a half. Yeah. And that's sort of the challenge is sort of getting lenders once again comfortable with the idea that it's okay to kind of tiptoe back into the water here. Uh-huh. You're not going to get your face ripped off. Yeah, so anyway, with all that being said, why are we talking about underwriting other than just that we're on this sort of gradual path? Really the reason is that there are 2 things that are sort of developments this month that are sort of impactful. not profoundly impactful, but impactful. The first has to do with Fannie Mae. So Fannie Mae is sort of constantly evaluating the landscape of mortgage underwriting. And one of the big areas where they've sort of found, we were talking about 1 million people a year not being able to get credit. One of the big sort of culprits, if you will, is the DTI ratio, the debt to income ratio.
Yeah.
And there's what's called a front end component and a back end component. The front end is how much is your mortgage cost between the principal and the interest and the taxes and the insurance as a percentage of your income going to cost you. And then when you add that to all your other debts, student loans, auto loans, credit card loans, what does that look like as a percentage of your gross income? Mm-hmm. And that's called your back end DTI, debt to income ratio. And basically what Fannie found after analyzing the data over the last few years is that a lot of would-be homeowners are being denied on their mortgage applications because their back-end ratios are too high. And so they also looked at loan performance for people sort of along this continuum, right? So they have the sort of data capability to say, well, let's control for everything else, and let's see how somebody with 45 DTI compares to somebody with 46 and 47 and so forth. And what they found is that there's not a lot of incremental risk of doing a 50% DTI back end to a 45.
Okay.
But it was costing a large number of people
Yeah.
from getting mortgages.
Yeah.
And so what they've decided to do, and this is effective actually in a few days, is allow people to go up to 50. Now, in practical terms, that's not actually 50 because there are these overlays, and that's going to hold it back. But the point is they've added 5 points. And 5 points may not sound like a lot, but it is.
Yeah. I almost wonder too, before you move on, what percentage of people are aware of this? You know, like say someone that went and got rejected, that's right in that right on the other side of that threshold. Like, do they know that they need to go back now? You know, I wonder.
Yeah.
Or if it's just going to gradually happen over time because, you know, someone that goes is going to get approval.
I think it's more the latter. Actually, on this next slide, we show sort of, this is a table. So the Federal Reserve basically tracks a lot of mortgage data, as you'd imagine. And interestingly, what they track, one of the things they track that comes from what's called the HMDA data set is the percentage of applicants who are denied mortgages, and specifically for what reason.
Yeah.
And so this chart basically shows the different categories. So you've got DTI, employment history, credit history, collateral, insufficient cash, unverifiable income, and so on and so forth. And the number one reason across all applicants for being denied a mortgage is the debt to income ratio is too high.
Yeah.
And that's why this move by Fannie Mae to bump that up from 45 to 50 is significant. So we think that's going to be a big deal. And I guess to come back to your question, you know, it's unclear whether people who sort of had gone through the process, applied for the mortgage, been denied, whether they're going to get a call back now saying, hey, good news, you should come back, or whether it simply means that on a go-forward basis, a larger net share of people who apply will be approved.
Right.
So we'll see.
I guess it's up to the person that's going to call them.
Right. Yeah. And then, you know, I had mentioned that it doesn't sound like a lot going from 45 to 50, but on this next slide, we sort of ran a scenario analysis where we looked at it and we basically said, well, if you held everything else constant, what level of student loan monthly payments could you carry, i.e. how much debt, relative to at a 45% ratio versus a 50% ratio. And interestingly, you can actually double the amount of student loan debt, more than double in fact. Yeah. You can raise it by about 123% relative to everything else. And that's important because student loan debt is still the fastest growing category.
Yeah.
Right. So I think this is going to be very helpful on the margin. And the other thing going on also basically right now, although technically effective at the beginning of July, you know, the reality is this will sort of seep through over the next few months here, is that the credit bureaus have made a pretty big change to what they report on somebody's credit history. And specifically what they've done is they've removed all reporting of federal and state tax liens as well as civil judgments. So there's like 12 million people in the country who have one or multiple of those on their credit file, and as a result, their credit score is a lot lower. So the process by which these guys are going to remove them from these reports is going to have the effect of raising a lot of people's credit scores. And we ran an analysis using data from Fair Isaac, so on this next slide here. And really what we were interested in was specifically how many people were going to be sort of above or below these sort of minimum thresholds, both for the GSEs, Fannie and Freddie, and FHA, sort of before and after this change. Because that's ultimately what matters,
yep.
right? So the cutoff for a GSE loan is a credit score, a FICO score of 620. And the cutoff for FHA is 580. So we tested specifically for those two breakpoints to see how many people. And what we found is that the number of people who would be above 620 after the change and were below 620 before the change was about 520,000. And the number of people who would be above 580 after the change but were below 580 before the change was just under 600,000. So that's a pretty significant number of people. And remember, again, in any given year, right now you're issuing about 3.5 million purchase mortgages. So to have 500,000 people who are suddenly eligible, who were previously ineligible, I think that's a pretty substantive change. So the DTI is the number one reason people get denied on mortgages. So that's now been given a little bit more room. And the credit score is the number two reason. And that's also now got a little bit of a tailwind for sort of curious reasons, but nevertheless. So anyway, I think those two things together are going to give a little bit of a tailwind to underlying demand here over the coming year. So the next thing we wanted to sort of think about was this idea of home prices, and specifically to do with the fact that you've got pretty healthy volume and AKA demand, and the outlook for that demand seems like it should be getting better over the next year with these underwriting standards easing. However, on the other side of that, you've got very tight supply, record low supply actually. So what happens when you have stable to slightly rising demand, but falling inventory, falling supply? Basically, the answer is prices go up. And at least historically, when you've had inventory as tight as it is today, you've tended to see home prices grow at a rate actually in the double digits. And as you can see on this chart, we're basically still in the mid-single digits at about accelerating, but at about 6.5%.
If you pulled this back, when was the last time we were at this growth rate?
Yeah, so basically, from really 2012 through 2013, we were growing, home prices were growing in the low teens, anywhere from 10% to 13%.
A lot of that just had to do with you're coming out of the housing crisis.
So suddenly, housing basically bottomed out in sort of November 2011, and then all of a sudden, as we like to say, it kind of went from bad to less bad, then from less bad to good, and then from good to great. And then by the time you got into sort of mid-2013, we started to decelerate. And we went from that sort of low teens year-over-year growth rate in home prices all the way down into low single digits. So very significant drop-off. And a lot of that was catalyzed by what's called the QM rule, the Qualified Mortgage Implementation.
Yeah, that's something you went over before.
In early 14. And so anyway, we're on the other side of that for the better part of a year. You can see it in this chart here from January of 16 really through early 17, sort of in this like sideways 5 to 6% range. But then more recently, things have started to accelerate again. And so, and then if we look at the composition of that on this next page, here we've got, these 20 cities. These are the 20 cities that Case-Shiller, S&P Case-Shiller track in their 20-city index. And we're basically looking both at growth year over year on the vertical axis as well as acceleration or deceleration on the horizontal axis. And you can see most markets are actually moving to the right. So basically, red was 6 months ago, blue is today. And you can see those are generally shifting to the right, meaning that they're speeding up. And New York is one of the big markets, obviously. The bubble size corresponds to the size of the market. So it's pretty broad-based. Seattle and New York are doing a lot better. And then I talked about this a moment ago, but we have this chart where we basically looked at inventory levels and their sort of predictive power from a future home price performance standpoint, meaning if you have low inventory, historically, what is that degree of inventory produced in terms of forward home price changes? And we sort of looked at it on a 3, 6, 9, 12, and 15-month time frame. And we sort of binned the different inventory deciles. and basically inventory is at its all-time low, so obviously it's in the first decile.
Yeah.
So the outlook for home prices to continue to creep up, I think is still quite good. And then, consistent with that, you've got this survey that comes out quarterly from Redfin, which basically asks people, a lot of questions, but this is specifically with respect to your strategy for pricing your home. And it's sort of like a gauge of greed, right? It's sort of like, do you think you're going to price it in the middle of the range, or are you going to price it high? And the percentage of people saying they're going to price it high went up a lot from 1Q to 2Q. And not surprisingly, the percentage of people saying they'd price it in the middle went down, right? So this tells you that people know that, sellers know that inventory is becoming a bigger and bigger problem, and they're basically translating that into more aggressive asks.
Yeah.
So, and then we've got sort of another slide, which really is sort of the same thing said differently. It basically says, people, or it asks them, do you think sellers have more power than buyers? Buyers have more power than sellers? Or, where do you think the power lies? And obviously, a pretty significant uptick in the percentage of people saying that sellers have a little more power than buyers. And then also, there's this third question down here that says, do you think sellers have all the power? And the percentage of people saying that went from 13 up to 20.
Yeah.
So those are pretty interesting.
Probably correlated with inventory levels.
Exactly. Yeah. And I think most people sort of see this in their own neighborhoods. When you sort of go to work in the morning, or you go out on the weekends. I think most people are accustomed to seeing for sale signs, and a certain level or volume of those signs, and it's pretty dry out there.
Yeah.
So
goes up and comes down right away.
And so then the next thing I wanted to cover briefly is that one of our favorite ideas on the long side in housing right now is Realogy, which is the largest real estate broker in the country. A lot of brands there, basically Century 21, ERA, Sotheby's, Better Homes and Gardens, and so on and so forth. And these guys, Realogy, have a tremendous amount of exposure to the high end of the real estate market, and that's because they have a lot of their sales that basically are generated either in the sort of metro New York tri-state area, Miami, and California. And so we're sort of interested, insofar as we follow them, in what's happening with the high end of the market. And so we included a couple slides that sort of look at some of these volume reports and price reports coming out for 2Q versus 1Q. And so this first one basically looks at what's happening, the trends that are happening in Manhattan. So to give you an idea, when you're a broker, like Realogy, you get paid both on volume and on price. So if volume's up 10% and price is up 10%, then your what's called dollar volume's up 20.
Yeah. Right.
So in the first quarter, you had volume up 7.7% and price up 3.2. So basically 10-11% growth year over year, which is quite good. But in the second quarter, you had volume up 16.5% and price up 10%. So you went essentially from 10% to 25 or 26%.
Wow.
So the high end is, at least in Manhattan, doing quite well. We looked at a similar thing specifically in the luxury market. Now these are prices north of $9.25 million on average, or $7 million at the median, and a similar trend. Basically, you had volume of homes sold up 1% in the first quarter, and then the second quarter up 15%. So that market is certainly rebounding nicely. The California market is doing reasonably well also. LA is doing quite nicely in Southern California. And then even Northern California, where affordability had become pretty extremely stretched, is still doing pretty well, bouncing back actually. And then we look briefly at Miami, where similar trends are there as well. So, sort of across the higher end landscape, you're getting a pretty consistent message, at least for now, that the numbers have been pretty good.
Yeah.
So.
Okay, so we'll go to the questions here, and the first, we'll call it the first 3 or 4 questions will be this rapid fire format. So you can answer however short or long you want. But the first one is, outside of the high end luxury market. So I guess I don't know if these are the right 3 to X out, but maybe X out San Francisco, New York, and Miami. Which market in the U.S. do you think has the most potential for price appreciation?
Well, the one, so if we go to this slide where we showed these sort of bubble charts, right, with the 20 largest cities in the country and the trends
34.
there. Yep. the one that sort of jumps off the page really is Seattle. So Seattle is just in the right place at the right time. They've got an unbelievable influx of technology workers.
Yeah, right.
They've got some mega employers. They've got Microsoft. They've got Amazon. At the same time, just north of Seattle is Vancouver. And about a year ago, almost now, Vancouver imposed this foreign buyer tax of 15%. And what we saw pretty immediately after that was a lot of that money, instead of flowing over from China into Vancouver, basically flowed about 50 miles south into Seattle instead.
Yeah.
So they've kind of got these twin tailwinds going on. And you can see it in the numbers. You've basically got home prices up 12, 13% year over year. And just in the last 6 months, that's actually accelerated over 200 basis points. So pretty clearly, Seattle is doing extraordinarily well right now. The other market that you'd be remiss not to call out based on this chart is Boston.
Yeah.
Boston has just had a pretty epic moonshot here. I'd like to think it's due to the relocation of our Hedgeye salesperson, Josh Bolsh, and the effect he's having on that market. Maybe or maybe not the proximate cause, but
that's hilarious.
That market's doing really well. And yeah, I mean, it's pretty broad-based. I think, we showed this LGI chart where their volumes in June were up 75% year over year. So the Texas market, really sort of, not so much Dallas, but certainly Houston kind of hit the skids when energy came off beginning in the second half of 2014 and then through 2015. But now we're sort of comping those sort of lower comps from 2015 and 16, and things are definitely getting certainly less bad, if not outright better there. And that's a major market for construction. It's like the largest construction market in the country, actually. Yeah. So, I think those are a few of the markets that are doing really well.
Yeah, that's great. All right, next one here. If you had to pick one, which housing market do you think falls apart first, Australia or Canada? I guess Canada's already fallen apart in some respects.
Well, yeah. So they're both a hot mess. They both have just extraordinary price appreciation that's been really fueled by extremely and increasingly sloppy underwriting. Yeah. And there's all manner of loopholes. And then on top of all that, you've had just this unbelievable influx of what's becoming known as HAM, hot Asian money, basically flowing into these markets. And it's our contention that these markets are sort of, at this point at least, built on sort of a foundation of sand, and you sort of pull the plug either on those outflows of foreign money or on the capacity of locals to continue to buy alongside that foreign flow, and you could really find yourself upside down extraordinarily quickly. Yeah. In terms of which is in the more precarious position, Australia or Canada, boy, that's a tough one. I think in the real world, you would never have to pick one or the other, but I guess it's kind of a question. From an investment standpoint, this is how I think about it. I tend to think that the excess that exists in Australia is worse. Yeah. I think the underwriting is worse, not by a lot, but by a little. I think there's some structural differences in the Australian market that are like almost unbelievable. Like they have things like negative gearing, which basically means that you're incentivized to basically lose money on investment properties. Really? They have interest-only mortgages, which is actually the majority of the mortgage market. Yeah. That basically you pay interest for 5 years, and then it goes in recasts to fully amortizing. You have a tremendous amount of home equity withdrawal going on in Australia. Canada is very bad. I don't want to sort of split hairs about that. Where I'm going with this is Canada is actually, even though Australia is a little worse, Canada is probably more actionable, and the reason why has a lot to do with the fact that, unlike Australia, Canada is starting to put up these gates.
Yeah, right. They're choking the host.
So they're basically making it a lot less attractive for your average foreign buyer to come in and buy Canadian property. And we've seen it in the numbers. So outside Toronto, so you have the Greater Toronto area, and then there's this sort of larger Toronto metro, which is called the Golden Horseshoe, which sort of extends all the way from way up north of Toronto down all the way to the U.S. border. and it sort of encapsulates that whole region.
It is a beautiful area. From if you drive from Toronto to Niagara Falls, that whole like wine country, it's really pretty. It is really pretty.
It is great to look at, but it's gotten more expensive.
Yeah, I can see why luxury, those
Yeah.
luxury homes are skyrocketing.
So look, I think so they passed this tax, 15% foreign buyer tax across the entire Golden Horseshoe, that went into effect in late April this year, and so. Now we've got data showing volume trends for June, and Toronto volumes are down a whopping 37% year over year. That's like an incredible decline. To put that number in perspective, when the U.S. had its housing market collapse, from peak to trough, volumes of homes sold in the U.S. dropped about 40%.
Wow.
And that was over multiple years.
Yeah.
And Toronto's down 37% in like 6 weeks.
Wow.
So, and I think it also speaks to this idea that, the sort of Canadian government likes to basically underreport the relevance of foreign money. And they sort of claim that Toronto property sold to foreign buyers is like in the low single digits, like 3 to 5%. But that just doesn't like pass the reality check when volumes are down 37%.
Jeez.
So anyway, so I think Canada is more actionable, and it's a big mess. But I think Australia is actually even worse.
Yeah.
We just don't yet have the spark, the catalyst there.
Sure. All right, let's go with one more question. So when you think about putting something on as an active best idea, either in the long or short side, what's your process? Is it a screening process? A lot of these companies you've known for a long time. Kind of what are you going through? Like, are you typically watching these companies all the time, and then it's like, oh, now is a good time? I guess if you could just walk through that whole kind of process and how you generate ideas.
Well, that's sort of the beauty of it is there's a lot of different answers.
Yeah.
And it's never sort of one thing and always just one thing. Two of the names that we have out there right now, Remax and Realogy, which we like both of them on the long side, are completely different stories. Remax is a great little company that is growing like a weed, and its growth potential is underappreciated.
Yeah.
And it's going to grow faster and for longer than a lot of people think is possible. It trades at a rich valuation, so it's going to have to sort of prove that valuation and basically earn its way into it. But the reality is that the growth is there, and the outlook for those guys is fantastic. Realogy, which is a much bigger company, Realogy is not as good a business as Remax. However, it got pretty cheap.
Yeah.
It really got hammered for a variety of reasons, probably the biggest of which was that the high end had slowed down a tremendous amount. And then we sort of looked at Realogy and we realized that between the reflation in the high end and this capital return program they had in place, there was just too many things that were going to go right over a 12 to 18 month time frame, that the stock wasn't going to work. And so, anyway, very different sort of approaches and reasons and rationales for why. But I think, at the end of the day, our mission is a pretty straightforward one. It's to try and find things that are either going to outperform or underperform relative to what people think. Yeah.
Okay.
So.
All right, we'll wrap up there. Thanks, Josh.
Great.
Thanks, everyone, for tuning in to this edition of Stock Talk. Next week, we'll have Josh's colleague, Jonathan Castellan, on. That'll be next Tuesday at 2:30. See you then.